Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by Austral Asset Management. It's Thursday, the 9th of February, and we have our regular Thursday guest, David Kuo, the founder of the Smart Investor Singapore. David, as always, great to have you on the show.
Yes, selamat tengah hari, Brian.
Now, selamat tengah hari. I'm going to come back to you in a little while, David, after we take a look at crypto markets and also how markets have performed across the region in the first half of the day. We're going to start with the SGX. We'll start, first of all, actually, with the crypto markets. Bitcoin's at 22,578. It's down 2.88%. Ethereum is at 1,623. It's down 3.3%. Now, looking across the regional stock markets, we've got the Straits Times Index, which is down 0.88%. Bursa Malaysia is down 0.2%. Shanghai is up 0.66%. The ASX All Ordinaries is down 0.56%. The Nikkei is down 0.21%. Hang Seng is up, however, 0.42%. And rounding up the numbers, we've got the Kospi, which is down 0.05%. Pretty mixed bag, David, throughout the region. Tell us why.
Yeah, pretty mixed bag. But at the same time, if you have a look at the markets apart from mainland China, Shanghai, and also Hong Kong, I would say that the indices were about as flat as a paratha. Should a paratha be flat, or should it actually be quite puffy? I don't really know, but as flat as a paratha, maybe. But if you have a look at what's going on in China and Hong Kong, just recently, Fitch has upgraded its growth forecast for both the Chinese mainland market and also for outside. And I think what they're suggesting there is that maybe the consumers in China will be able to propel growth in 2023. So on that point, I think it's quite interesting that there is a ratings agency out there that is prepared to upgrade China, and that could account for maybe why, China and Hong Kong are up. I want to raise one other point, Brad. I know we have a limited amount of time, but here's something really interesting that I noticed. If you have a look at the Dow Jones Industrial, in April 2021, it was 34,000 points. Today, the Dow Jones Industrial is 34,000 points. So in 2 years, the Dow Jones has gone absolutely nowhere. I think this is more or less reflective of markets around the world. As we came towards the peak of the pandemic, and when the pandemic started to subside, people realized that they needed to go into the stock market, but they were unsure as to what was going to happen with regards to, number one, interest rates, and number two, corporate earnings. And so they dipped in and out of the market. So during that 2-year period, from April 21 until now, February 21, and I would predict that by April 2023, the market will still be at 34,000 points, because people have no idea as to where the market is going. Is it going to be interest rates that is going to control the market, or will it be earnings that will control the market? And so for long-term investors like me, these past 2 years have been fine. I mean, the index has gone absolutely nowhere, but at the same time, I just keep on collecting my dividends.
Your dividends. But speaking of interest rates, David, the conversation has now shifted, and expectations by investors of what terminal rates could be have gone up. We're talking about 6% now. What are your thoughts on this?
Good segue, Brian. Yeah, and I think, what some traders are saying is that when you have a look at the Fed fund rate at the moment, it is well below the inflation rate in the US. So what they're predicting is that the Fed fund rate will be higher. And when you hear the narrative from many of the Federal Reserve officials, they are suggesting that interest rates will be higher for longer. And even Chairman Powell said that interest rates will have to creep higher. So how much higher will it go? A lot of the people in the market say, maybe 5%, 5.5%, but there are some traders out there that are betting that the interest rates could be as high as 6% by September. And this almost echoes something that Jamie Dimon said in January, that he wouldn't be surprised if interest rates went as high as 6%. And at that time, jaws dropped and people said, surely not. I mean, surely the Fed couldn't possibly raise interest rates to 6%. But it's looking quite likely now, especially this rhetoric that's coming out from one official after another from the Federal Reserve that is saying that interest rates will have to rise, and the market doesn't know what to make of it. So we go back to what we're saying. I have a suspicion that, yes, interest rates are going to be higher, but will corporate earnings be able to propel their bottom lines, and will they be able to propel their share prices higher?
Now, David, I want to bring our audiences back to what you've said last year very consistently, which is basically we cannot have real interest rates significantly lower than the inflation rate. And so when we were hitting the 8% mark, you were already saying that, hey, this is not, I think investors are unrealistic to think that rates are going to be below 5%. And you've been proven correct.
Well, I don't want to take all the credit for that, but it's just that it's common sense, Brian. When you have inflation that is high and interest rates that are below the rate of inflation, it really means that whatever money you have in your pocket, say you earn 4% or even 5% on it, but inflation is running at 6 or 6.5%, it effectively means that you're losing money. So you put $100 in the bank, and at the end of the year, you get $5 worth of interest. You think, oh, $5 nominal is quite good. But in reality, prices have gone up 6%. And so therefore, your $100 is not going to be able to sort of buy, even with the interest, $105 is not going to be able to buy something for $105 because that is now costing you $106. Where does that extra dollar come from? It has to come from somewhere, which means that it's coming out from your pocket, from your savings. And I think this is something that people fail to recognize, that there is a big difference between the nominal rate and the real rate. And the real rate is when you deduct inflation from what you've got. And unless companies can raise their dividends or raise their earnings by above the rate of inflation, they're really losing money, Brian. And that is something I don't like to do, losing money.
And David, so this brings me to the point of the fact that companies have to find either to cut costs or basically raise prices or raise their sales. And we have the likes, and so this is where pressures on earnings for companies are going to come in. And we have the likes of now Disney reporting that they're going to cut 7,000 jobs with the hope that it's going to save 5.5 billion US dollars. Now, what's your take on that, and what the old new CEO is doing?
The old new CEO. Well, I think a lot of people were hoping that Bob Iger would be able to turn around the company. When you have a look at the share price, it does look as though he has turned around the company. Since Bob Chapek left, the shares of Disney have risen quite significantly. So there's a lot of hope there. But I sometimes wonder if it's hope over harsh reality. And the harsh reality is that Bob Iger came in, he said he would restructure the company, and he has done cosmetically. I mean, he's turned the company now into 3 different segments. He's got entertainment, which takes in all the streaming media stuff. He's got ESPN, and he's also got the parks. Right. I don't really sort of call that a radical restructuring. Even I could have done that, and I'm not Bob Iger. But the other thing, of course, is that the elephant in the room, Brian, is the amount of debt that Disney has. When Disney went out and bought, the assets from Fox, it borrowed the money to do so. 10 years ago, Disney only had about $10 billion worth of debt. Today, it's got close on to $50 billion worth of debt. And Bob Iger kind of glossed over how he is going to get the debt levels down. And he's hoping that by firing 7,000 workers, he'll be able to save some overheads, some costs. But at the same time, he's still got the streaming media, which is facing a lot of competition from a lot of different companies. I mean, the most notable one is Netflix. Then you've got Amazon Prime, you've got Apple, you've got Peacock. So there are lots of companies out there that want a share of eyeballs. And what is Disney going to do? Is it going to put more money into content? Well, if you put money into content, it is a big risk. And a lot of people, I remember many years ago, somebody asked me if I would be interested in investing in a film. And I looked at the filmmaking industry, and most films lose money, Brian. Yeah. Occasionally you hear about Wakanda Forever, you hear about Frozen, you hear about these things that are
But that's a
blockbusters.
tax thing that people invest in when you invest in films.
I beg your pardon?
That's a tax dodge, especially in places like Australia, that you invest in films because basically you could do a tax write-off, and there's quite a number of gains depending on the markets.
Well, that was the way the guy sold it to me. He said, you don't really need to make money. You just write it off as a tax loss. And I went, well, I can find better ways of losing money without actually sort of having to go into the film industry. But the point is, you put a lot of money into movies, and it's a bit like the pharmaceutical industry. You put a lot of money into research, but once in a while you end up with a blockbuster. And it's a bit the same with the movie industry. You don't always make money in the movie industry. And so I really don't know what's going to happen. People are speculating that Disney could spin off ESPN. And if they does that, then I think that could be the best thing for Disney, to spin off ESPN into a separate entity listed on the stock market. And if you want to invest in ESPN, then do so. But let's just keep Disney as being what it was previously, theme parks and also movies.
Now, final question, David. You talk about companies that will do well in a rising interest rate regime. Banks are a classic case of industry that does very well with rising interest rate because of net income margins. Singapore banks are announcing their earnings next week. What are your thoughts, and what are you looking out for from the banks?
Well, the banks have already risen quite sharply, over the past few months. And I think people are expecting the banks to produce good results. And I don't think they will be disappointed, simply because of what you just said. It's that net interest margin, the difference between what they pay savers, which is now reasonable. Previously, it was pitiful, and what they charge borrowers, which is still quite high. So that difference between the two, what they pay savers and what they charge borrowers, is the net interest margin, and that has been rising. And so consequently, it's low-hanging fruit for the banks. They will be able to make money from that. The counter argument, of course, is their provisions for bad debts. Singapore banks have, in general, been quite rational in terms of providing for non-performing loans. So I think we're going to see some good results from DBS, OCBC, and also UOB when they do report results. And I saw today a few of the analysts are suggesting that maybe these banks will be able to pay a special dividend based on the amount of excess profits they're going to make. They're not going to raise the base dividend, because once you do that, then of course you have to carry on using that as a benchmark for future dividends. So maybe they'll just keep the base dividend as it is, maybe a little bit higher, but at the same time, we investors like myself who have shares in DBS, UOB, OCBC, and of course 2 Malaysian banks, Maybank and Public Bank, and the Indian banks. And I think we'll be looking forward to some good payouts from these lending institutions.
Now, David, as always, thank you very much for your insights. Thanks for coming on the show.
Thank you.
We've been speaking to David Kuo, founder of the Smart Investor in Singapore, on BizTech's Asian Midday Market Watch, powered by Austral Asset Management. I'm Brian Fernandez. This show will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.